In this video of Market Trader Lesson 2, what I'm going to do is recap the supply and demand concept that I had gone over in class. Now, supply and demand is a interesting way to look at charts. And from the handouts, the idea is that you need to be looking for areas where you have what's called extended range or exciting candles, because those areas are the ones that have tremendous amounts of buying or selling pressure. And usually the origin of those areas is a very, very high probability that if price ever does return to that spot, you will get a turn in the chart. So it is kind of like fading a move to the downside or fading a move to the upside. Um, what it can be, though, is a low risk, higher probability point of entry, or a place where if you anticipate price changing, you can then be adjusting your hedges accordingly. You can either be more aggressive or less aggressive with whatever options you're using to hedge your underlying. So to get started, I'm just going to look at this chart here of Tesla Motors. And the first thing I'm going to point out to you is that this is a weekly chart indicated by the W up there. So a weekly chart means that each bar on the candle chart, and this is a candlestick format chart, contains 7 days of trading. So I've pre-marked a couple areas here that I want to talk about. So currently price, when this chart was taken, was price for Tesla was trading at around $151 a share. Um, the area that I've marked just above it, and I'm just going to circle that right here, okay, is an area that I consider to be called weekly supply. Okay, and the reason it's supply is it's the origin of a very, very strong move down. As you can see, there were 3 candles, including the current price one, where price just dropped away from that zone. And price also kind of paused there for a couple of weeks. It had previously fallen, fell. So I'm just going to point out, fell here, kind of paused here for a couple of weeks, and then fell really hard away from that zone. So this is an interesting area to keep your eye on, because if price ever were to retrace into this area here again, as soon as it gets into this zone, because of all the selling that previously happened, we would expect price to then fall away. So you can consider this as being resistance. I use the term support or supply, meaning that there's an extra amount of selling. That's the origin of selling at this point. The other point I want to get you to focus on is the one below here. I'm going to circle. That is an origin of demand, meaning when price was in that area, it had come down and sort of hung out there for 1 week and then blasted off from that area and moved strongly away from it. So we could expect that if price were to ever return to this area here, that we would expect a pause or a turn in the price action. So as you can see, we're currently at 151. So if the price, now Tesla's a stock that can move, if the price ever drops more, another $20 or so, we would be getting close to this area here where we'd expect price to turn. Okay, now interestingly enough, right above it, there is another cluster of trading, and you can see that price also rocketed away from that zone here. So that is an area of demand that you could consider demand, and that if price ever were to return to that area, like it has, you would expect a pause or a slowdown in the selling. Okay, and that's exactly what happened. When you can see with this candle right here, that there was some hesitation as price went in and kind of created a wick, meaning that there was a lot of buying and selling, but the actual net change in price wasn't so great. And it's due to because of all that demand that was sitting in that area right there. Erase that. So we would call this weekly demand. So the best we could look at is on a weekly chart with this particular stock. We would say that we would expect that buyers would be coming in at around the 127, $130 mark, and that if price ever returned up to the $199 mark, we would expect more sellers to come into the market. So those two ranges, the supply and the demand part, form our trading range that we can expect this stock to be bouncing around in until some other new areas of supply or demand begin to form. Now I'm going to look at another chart. This is the USO chart. So this is our low priced ETF. And you can see that oil has really fallen quite hard um, from levels beginning at around the $34 mark. So just from our previous discussion on supply and demand, there is a lot of selling that happened. And this is a monthly chart. So monthly is even stronger than weekly. And we see three huge bars dropping away from that $34 price. That tells you something. That tells you that there were lots and lots of sellers at that price, and there probably still is unfilled selling orders in that 34 range. Price now, though, is trading at around 833, so this is quite low. So if we look up the the um, the chart, we see the first cluster of prices to be around 1456 to 1609. This is our first level of supply above current price. And then going a little bit higher, we have another little range here where price fell away and then kind of paused. So that is another level of supply. So we have actually three supply levels here in oil. And they're all actually on the monthly chart. So what that really is telling you is that there were lots and lots and lots of trapped sellers um, for sure at these three levels. So if you're expecting a really strong rebound in oil anytime soon, it's probably not likely to happen. Because first we're going to have to test and break through the selling pressure at the $14 level. And then we're going to have to break through that and test and break through the $19 level. And then test a huge supply level at the 34 level way above. So there's considerable movement for price to rebound. And again, we are looking at a monthly chart here. So that is an extended amount of duration of selling. Um, they couldn't find enough data on the chart to actually find out where a demand zone would be for oil because this particular chart didn't go back far enough. But you can see that you're going to have to go back pretty far in time to find out when oil last was trading at a very low price and with a significant amount of demand. So for the right now, I would be your play if you were trading USO is to basically be selling rallies if any prices do retrace up, and to be setting your essentially hedges around the 14 and the $19 mark, anticipating that price will fall once they ever break up there or get up to that level and then penetrate that first level and then probably fall away from there. So that's the look on oil right now. I think it's going to be quite a while before we see significantly higher prices.